Clearly, it's not the result we were looking for. There's stuff to clean up. There's things to fix.
Hello. Paysafe stock just tanked over 40%. Yes, the company literally lost $2.3 billion in market cap in one day! This all comes after they posted their third quarter earnings and completely fell apart once they were done with the earnings call. What sparked this unholy sell-off, and was the earnings call really that bad? Sometimes in life, and without question, to be a good investor, you just have to admit when you're wrong, and that in turn makes you stronger to move forward. I think I was clearly wrong on this company in the short mid-term. But what am I going to do with my Paysafe stock right now? Remember, the stock market and investing in stocks ain't to all rainbows and unicorns. Stay tuned for a quick drill and more. Keep it simple. Well. Like in football, when a side gets killed on the blind side. This is exactly what happened to us longs on Paysafe stock, even though there were some clues leading up to this meltdown. CEO Philip McHugh and CFO Izzy Dawood set off down a path where I believe they knew they would literally be throwing the company under the bus. Maximum pain on shareholders ensued, but did they have any other option? Were the numbers all that bad, or was it simply an inside job? Or is it just poor management and presentation? Where is Bill effing Foley? And where's the stock likely to go in the run-up to the end of the year now that Q3 is officially in the trash? Remember, I ain't no financial advisor. I'm just a simple trader, so no more plugging, and let's start drilling. Okay, without further ado, let's go over some of the key numbers which I believe led to the almighty crash of the stock.
There is no sugarcoating that our financial results are disappointing and not up to our expectations. We have a strong plan to get Digital Wallet back to double-digit growth, but we have to go through the necessary transition in 2022.
First things first, when you report that you have missed revenue guidance, it's bad enough, but for a tech company promising growth since going public via a SPAC, in all previous earnings releases to come out and then report a 1% decrease in revenues year over year raised all kinds of red flashing lights. Call the cops. This is clearly a significant number that sparked a huge sell-off. This is mind-boggling despite a 19% increase in total payment volumes, which amounted to 31.1 billion. The next metric must have shareholders like me drooling in pain. Net loss attributable to the company was $147.2 million compared to a net loss of $38.1 million year over year. It doesn't get any better in the commentary as CEO McHugh spelled it out for us. As he says, in the third quarter we reported adjusted EBITDA in line with our expectations, despite softer than expected revenues, reflecting both market and performance challenges within the digital wallet business. This is a trend that we saw throughout the earnings call too. It appears the digital wallet part of the business is failing, and to me it seems like it's dragging the whole business down.
However, there is work to do in digital wallets.
Is it all bad? I don't think so, and these highlights suggest to me that the 40% sell-off was a little extreme. They reported a 50% year-to-date revenue growth in the North American iGaming sector. This is pretty big. As we all know, iGaming is booming in the US and set to grow big. In this regard, they remind us that they announced several new and expanded US iGaming partnerships, including Fubo Gaming, PlayUp, and Superbook Sports. Continued rollout of the Skrill USA digital wallet revamp, expanded eCash partnership to support cash consumers to pay bills at more than 4,600 Walmart stores across the US, acquired fintech companies via Fintech, SafetyPay, and Pago Efectivo, and they note they exceeded cost savings targets, delivering $26 million in savings year to date. On any earnings, this would all be very bullish, but not so for Paysafe. Going back to the total revenues, they note which was at $353.6 million, which is a decrease again of 1%, but this was partially offset by a $7.7 million impact of a business divestiture, Pay Later, in October 2020. Excluding this, revenues actually increased 2%. This section is a key for investors to really drill into, but I must admit it's all becoming spaghetti and hoops unless you can understand what the hell they are saying. Okay, simply put, they had a divested business and there was an exit of certain clients in the direct marketing vertical within the integrated processing segment. What's a divested business? It simply means a partial or full disposal of a business unit through a sale, exchange, closure or bankruptcy. So Pay Later was the business segment of Paysafe that was sold in October 2020. And what about the exit of certain clients? I'll be honest, bottom line is this does not look good for their integrated processing segment. If clients are leaving, there is still some hope in that if these are excluded, then in fact the revenue growth is approximately 5% year over year. This wouldn't necessarily be a good mark either, as for tech companies, the market generally expects double to triple digit growth values. I don't like the final sentence here though, where they say growth was partially offset by a decline from their digital wallet segment. Remember, I said their wallet segments would be a theme here. Well, there you go. When we flick through the earnings presentation, the first thing we are smacked with is the key messages, and this is actually not too bad. In fact, they make a deal to highlight again that revenues actually grew 2% year over year, excluding the Pay Later divestiture. Again, in this slide, they highlight the trending issue, which is their digital wallet segment is facing weakness and which will likely roll into Q4, and that is shown in the next slide. In Q4, they are expecting even weaker results here. I think this was a big factor as to why the stock tanked 40%. Let's go into this slide, which compares their previous guidance to actual Q3 results. Based on this, I don't think Paysafe actually believed a 40% price tank would have happened. Why? Well, they missed guidance by only $6 million for revenues and gross profits by only $1 million. They hit adjusted EBITDA and cost of services forecast. This just goes to show how unforgiving the current market is with regards to the need for explosive results. Okay, with Paysafe, we all knew, as highlighted from day one, that they do have a big debt situation. That situation has not gotten much better since going public, and it still stands at over $2 billion. This slide says it all, and moving forwards again, they will need to either dump or reboot their digital wallets if they are to succeed.
As you mentioned before, we will pay down debt as fast as we can with the excess cash flow to bring that down. So obviously our long-term commitment to 3.5 times is still there. It's just going to take us a little longer to get there.
If there is going to be any metric that we expect to have exploded on an earnings call like that, it would be the short volume. And we can see from Fintel that the short ratio jumped to a crazy 58% on the FINRA dark pools. It's absolutely crazy, but it does explain how and why the stock tanked 40%. I will say this though, that to me it is clear the CFO realized what a poor job they have done and so decided to do a Q&A session on his Twitter page, which was to me a clear damage limitation move. In fact though, some of the answers he gave there are more insightful than the dull, defeated textbook answers he gave in the earnings call. What is interesting is that Dawood basically proclaimed he will be buying 100,000 shares, and when asked if any other insiders would do the same, he hinted that there are plans in place. That could be a nice way to try to turn things around and give some positivity around the stock, and the retail investor engagement is actually a very positive thing in my opinion, but I feel the short-term damage to the stock has been done. Without some solid maneuvers, I don't think the stock will recover anytime soon in the short term. Now, listen to some of these extracts from the earnings call and tell me what on earth is McHugh and Dawood being paid to do.
But we don't see that reversing in like a very near future. It'll probably take a couple of quarters to get there.
But like what percent of the European digital wallet business is Germany plus Netherlands, just so we have an idea how to kind of draw a box around this?
Yeah, good question there. I don't have it down on my fingertips, but given Germany's relative size in Europe, it's a pretty large marketplace. Obviously, UK is a big market as well, and other places we operate in.
But Jason, we can follow up offline. I can provide you more information on there.
What role is Bill Foley playing these days with regards to the company and the ongoing issues? And then the second, you said that 2022 is a reset year and that you expect growth to come back in 2023 as you right the ship. But instead of having shareholders wait until 2023 to see if the ship can be righted, and you are raising some serious issues that the company's facing, have you considered that at this juncture the best way to create shareholder value is to potentially explore selling the company? Thank you.
Yeah, thanks, Josh. So I'll answer on the bill and on the second question. So look, Bill and I, we speak on a weekly basis. He's engaged. He's aware of all the issues, good and bad. The board is also very, very active across the board in terms of all the points. So look, in terms of the conversations, he's clearly disappointed in the performance and the fact of the cleanup that we have, that we've got more to do. And he and I are both working very closely on the actions we're taking, the right sizing of the organization, the stripping out of some areas. So he's involved in those pieces quite a bit. He's equally involved in the upside we get from both the inorganic and the organic deals that we're pushing, and sees the opportunity, the momentum there. So you'll have to speak to him personally, but I think it's definitely not happy with the outlook and performance, but also sees the value of where we're growing in iGaming, growing in crypto, and growing in some of the disruptive areas that were always the attraction of Paysafe. So that's the conversation with Bill.
On the back of such craziness, expect there to be some consequences. To summarize, if any stock crashes 40% in one day, you would have thought it's likely going down the drain. But if you paid attention to the price action on, say, a 15-minute time frame, most of the dumping was done pre-market and pretty much at open and close, which kind of signals to me that dumping was by large holders of Paysafe, like the funds or hedges at the start and at the end of the market. Now, with a disgusting crash of 40%, if the stock was indeed garbage, shouldn't it continue to go down? Well, on Friday, the stock actually recovered 6% to close at $40.50. No one can predict the future, but I do feel the stock could take another hit or several hits before it recovers and starts climbing. For a $1.4 billion revenue company to be priced at $4 and have a market cap of $3 billion, let me repeat that, $1.4 billion revenue, but $3 billion market cap. I think the floor is certainly close, and if you think about its peers such as SoFi, who have been given guidance of $0.9 to $1 billion revenues, but has a market cap of $20 billion, you can start to see that if Paysafe fixes their debts and their other problems and starts growing as intended, then what they're currently priced at presents a great situation for an early investment.
We don't have a conversation on selling. We know it, starting from myself to the board. Don't see us at this value. We know their low point. We know there's credibility to rebuild. But as I said in my comments, we see the deals that we are signing. We see the areas that we can fix, and we see the way forward.
Yes, their debt problem does need to be fixed, but I do see next year as the potential turnaround year, and when they can fully get the Foley playbook in play. And it's good that they actually came out to admit their digital wallets need fixing right now. Thanks for watching, and please note, for me, Paysafe was always going to be a high risk, high reward, 3 to 5 year growth play. I actually did buy some more shares on Thursday's crash. Yes, I am down and I am hurting, but long term, I think I still have reason to believe they can succeed, despite my previous strong sentiment towards the company. Remember, things change, and investing in stocks changes all the time. So to be successful, sometimes you just have to take a hit. And remember, the market is always changing, and most of the time, the way stocks move is not necessarily based on logic. Please take this drill with precaution, and always do your own DD. If you found this video informative, then please do me a simple favor and just consider subscribing to my channel so you can get a pop-up when a new video is uploaded. I am a simple trader. I try to keep this simple, and will simply see you in the next video.